scary economic data, and the price that you have to be watching for Bitcoin. Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Happy 4th of July to everybody celebrating the birth of this great republic here in the United States. In today's video, I want to go through the latest in the economy. We're going to talk about the stock market, rates, and of course, the Bitcoin price. Let's start with unemployment claims and the data that came out yesterday. Let's start with jobless claims. So this week we got information out of the Bureau of Labor and Statistics that continuing jobless claims are on the march. So in this chart here, we can see that there are 1.86 million people on continuing jobless claims, and this is the highest it has been in the last few years. Obviously, this number spiked way higher during the pandemic, but now in this current state of economic expansion, we are at the highest point of people filing on an ongoing basis for unemployment assistance. So this is a metric that is, in our opinion, it's a tier 1 metric. Jobless claims is a data series we get every Thursday. It can be noisy and it can be seasonal, but continuing claims right now are showing us a clear trend in the labor market, that the labor market is getting weaker. This is supporting the idea that the Fed will cut rates this year. We'll talk much more about that in this video, but I want to show you guys first, starting with the labor picture. It is getting worse. But the unemployment claims data was not the scary part of the week. The scary data came on Wednesday morning with ISM Services. So I'm going to show you the print here. On this graph, we have two data series. We have the ISM Manufacturing, which hit Monday, July 1st, and then we had ISM Services, which hit Wednesday today on July 3rd. Now, both of these numbers came in below 50, but the most important read here is that services came back down into contraction territory and are actually at their lowest point in the last several years. Now, this is the scary data because what we have been expecting so far in the economy, and I think what the Fed is expecting and what the markets have been expecting, is that the economy will hang on and not go into a recession anytime soon. People have expected a slowdown. Obviously, the JOLTS data from the last few months and other unemployment claims data has shown us that the economy is weakening for sure. Manufacturing has been weak for a while, but this dip of services below 50 once again is definitely getting us back into more of a recession watch. So we'll need to see further confirmation here. And I want to say something also. I find it very curious and interesting that there are people commentating that ISM is a noisy data print. That is, we believe, far from the truth. You can see here on this picture that the economy dipped and spiked, and it's been slowing down for the last couple years, but still most of it has been in expansion territory. Look at the services. Above 50 for the last couple years. Most of the U.S. economy is services, so that would corroborate a growing economy. So this is not a noisy data series. In fact, it's one of the highest signal data series that we can take. And the Fed is definitely paying attention. So services coming in below 50, below 49, as well as manufacturing sticking below 50 is showing us that the U.S. economy is definitely getting weaker. And I will show you the GDP estimation here shortly. Okay, we've been thinking about inflation a lot. What is the path of inflation? In green, we have CPI, and back in the orange and purple, you have the ISM Services and Manufacturing prices component. So the inflation metric within these two ISM data series. And what we saw is that inflation did pick up a little bit over the last year, but it does appear to be cooling once again. So that should keep inflation broadly from going up. We've talked a lot about rents. Jerome Powell's fixation on the latest realtor rent indices across the country, how rents coming down will keep a lid on inflation, and how that will translate into the Fed communicating to the market that the risk of runaway inflation is now gone. So the Fed doesn't want to come out and admit this, but when they say we're going to cut soon, their probability distribution suggests that they believe inflation has peaked. And it's really a small probability that it reaccelerates here for the Fed. And this chart and what we saw this week from ISM prices does help to confirm that. Here is the ISM Services and Manufacturing headline prints, which I showed you a couple charts ago, as well as the employment sub-indices of those two. And we can see that they're all back below 50. So this was the case a couple months ago. We flagged it for you guys. A couple of them popped back above 50 last month, but now both of the indices headlines are below 50. The employment indices are also below 50. What does that basically mean? It means American companies are firing workers at the margin. That's what this data is telling you. The unemployment claims, continuing claims data showed you that as well. So we will be watching the labor data to confirm that we are in a slowdown that is warranting the Fed to come in and move rates lower. And they will be moving rates lower, guys, within the next few months. We don't know if it's July, September, or November. We've been saying September for a while. We'll stick with that call, but the Fed will be cutting rates, guys. Here's the GDP estimation. So this is the Atlanta Fed's GDP now. It is back below 2%, and this is actually the lowest reading of the year. And it's not in recession territory, of course, because we know recession is a contraction of the economy. But with 1.5% real GDP growth, we don't see the recession here on this chart. But again, you have to think about where the economy is heading. And with companies firing people, the consumer will slow down as a result of that. So we're watching these things unfold. I would also recommend people go check out the episode that we did last week with Melody Wright on the residential real estate market. We think it's a very important topic right now within the economy, what's going on in residential housing. It appears to be slowing, but in terms of the real negative impact, it does look like next year is going to be that year for the housing market where inventory issues run into weak demand and a weak consumer. So go check that one out with Melody Wright, fantastic housing analyst. Last chart on the economy here before we shift gears to the markets. In orange, I have for you the Citi Economic Surprise Index, and you can see that it's tanking. Now, I have this relative to stocks, and I want to explain the Economic Surprise Index for a second. This is an index that measures economic releases versus where the expectation was going in that morning. So when the number goes down, it means that the data is missing expectations. Now, you can see here that there's some relationship, but a lot of it is inverse. So sometimes when data beats to the upside, the stock market goes down. Why is that? Because when data beats to the upside, it means that the Fed is more likely to hike rates, make things more restrictive, and that depresses present value valuations for the stock market. And so when economic surprise is going down, it means the Fed is more likely to ease, and that should potentially support stocks. So we're looking for that dynamic going forward that should be supportive to liquidity broadly, and we are looking for the S&P and Bitcoin to be supported here as the Fed moves into more easing. Again, the asterisk is a massive recession and a risk-off event that is more associated with a banking crisis or a liquidity crisis. Risk markets, let's talk about the S&P 500. We've talked about the breakout above 4,800. The S&P just keeps testing new all-time highs every few days. We right now are looking at the S&P telling us that liquidity globally is supportive. This doesn't tell us that the economy is doing great. This just tells us that conditions are supportive. If the economy was doing great, we wouldn't see ISM Services, manufacturing, and these employment sub-indices all below 50. Shifting gears to the money markets, I want to look at repo rates really quickly. We had a spike in repo rates going into June 30th. That was, of course, expected as repo rates are largely driven by the calendar. When banks need to make their books look nice going into month end, quarter end, or year end, they make sure that they don't have any extra cash items that might not be palatable for their investors. Other positions, they make sure that they put that capital into safe instruments such as T-bills or the reverse repo program. In that way, reverse repo spikes, and the banks also have to attract repo funding to make sure that all of their positions are funded going into the month end. And so how do they attract funding? They have to raise repo rates. And so we see generally repo rates spike into a quarter end. And that's what happens here. We saw repo rate spike. Remember, that's banks attracting funding to make sure all their treasury positions are funded. And then the rates come back down. So we should see these rates come back down a little bit, but we always have our eye on repo rates for you guys, because repo is where we might get a signal that there's some tightness in the financial system, either with reserve scarcity. We're always talking about ample reserve, so we're watching repo rates for these reasons. Now let's talk about Treasury yields. We'll start with the 2-year yield. We see the big drawdown in the beginning of 2023 as there was a banking crisis going on. But because the Fed came in and bailed out the financial system with a BTFP new facility, and the government came in with unlimited FDIC insurance, we had a relief of that, and basically the pricing in of no rate cuts. The rate cuts got priced in because of a financial crisis. The Fed and the Treasury fixed the financial crisis extremely quickly, sent yields back up. We had a growth scare last year, and we're having another one this year. And you can see that with the Fed's rate at 5.25, Treasury yields in the 2-year part cannot get above 5 because investors just do not believe more rate hikes are coming, more inflation is coming. They believe the opposite. Disinflation is coming, rate cuts are coming. So let's lock in these 5% yields in the 2-year part of the curve. So we look for 2s to continue to be well bid, meaning the yield will not go much above 5, even if it does get there again, because we are getting rate cuts. So it should send 2s down toward more toward the 4% area, and that should help to uninvert the curve. Nothing on the yield curve today, but make sure you guys are subscribed to our free research publication at thebitcoinlayer.com/subscribe. And TBL Pros are able to access exclusive research, live virtual Q&As, and our new mean, median, and mode weekly quantitative report. 10-year Treasury yields are chopping around this support level, and now I want to bring politics into the mix here. We had a massive shift in presidential politics this week, as well as a massive shift in future legislative politics last week with the overturning of the Chevron doctrine from the Supreme Court of the United States, and then this week the pricing in of Donald Trump becoming president number 45 and 47. Now, what you saw with Treasury yields after the presidential debate was a large spike. Why? The market might have been pricing in some sort of huge fiscal stimulus that would extend the deficit and steepen the yield curve. We also, though, did have quarter end to make Friday's trading a little bit noisy. This week, rates came back down as the economic data was weak. So, my point here is that presidential politics might affect Treasury yields, but the economy might matter more. So let's keep our eye on this trend line, because if it holds, it means that we're probably going to get a re-steepening of the yield curve. But if it doesn't hold, it means that we are heading for potentially a recession. And the inverted curve should put the pressure on the Fed to not just cut rates, but slash them by 2%, closer to 3%, instead of just 25 basis points a couple times here over the next 6 months. So this trend line will matter a lot. We'll talk about the Bitcoin trend line here in a second, but this trend line on 10-year yields matters a lot. 10-year yields are down today as we have gotten weak economic data, but this 4.25, 4.33 level, very, very important to watch. The last chart I have for you guys here is on the Bitcoin price. So we'll talk about Bitcoin adoption here in a second, but on Bitcoin price, go check out Joe's video from earlier this week on Bitcoin and some of the things are affecting Bitcoin's price, including correlation with the S&P 500. We think that's very important, but today's study is purely on this support trend line that has been in place since the court case overturned when the SEC lost to Grayscale and ETFs became inevitable. It kicked off another bull run in Bitcoin. We are approaching that level. So I want to point you guys to this $58,000, $57,000, $59,000 area on Bitcoin. It is very, very important for Bitcoin to hold this. Otherwise, it opens up this $50,000 to $47,000 area on the downside. We still believe Bitcoin is in a bull market. And so what happens around 58,000 is going to be very important. And technically, it will matter a lot. If we get a bounce, Bitcoin will bounce nicely. And if it doesn't, I am almost certain that we will get a drawdown in Bitcoin to the low 50s or potentially even lower. Remember that this is not investment advice, and we definitely do not give trading advice here. We are trying to analyze these markets. You guys may or may not know, I personally am not trading these markets. I don't think that that's a wise approach to the Bitcoin market. So Bitcoin, $58,000 is going to be a very important area. It's close to that area again this morning, but we will be watching to see how Bitcoin behaves. Now, remember, it is our thesis that liquidity is broadly supportive. Central banks will be coming in with more rate cuts, potentially the expansion of balance sheets, or at the very least, an elimination of the reduction of balance sheet size. We also believe that fiscal deficits will continue. That'll be supportive to the spending impulse from the government, which gets money into the economy. All of these things should be supportive to risk assets, including Bitcoin. That is our going thesis. But we have to be very cognizant of price support resistance levels. That's why I'm flagging this trend line for you guys. I hope you have a fantastic and safe July 4th. Happy birthday to the United States of America and this great republic. And Bitcoin has a home here in the United States. So when we think about Bitcoin adoption, we see Bitcoin finding a home in the United States. And we're very bullish on Bitcoin adoption here in the US and the US being a global leader to show the world that Bitcoin is a technology that is worth investing in and worth supporting in terms of building out its infrastructure, just like we did with the internet here in the United States of America. So happy July 4th. Have a great Independence Day, and we'll see you guys next week here at the Bitcoin Layer.